think the markets have rallied in quite a meaningful way over the last month, more so than anybody ever expected. We're in the camp of a W-shaped recovery. We've been taking some profits and reducing our exposure gradually because we're expecting more volatility. The volatility is really going to come from a couple of areas. One is Q2 earnings, which you'll start to talk about in quite a meaningful way over the coming weeks. We're expecting quite significant declines in revenues to the tune of around 12% and earnings to the tune of around minus 43%. The other thing that we've got is obviously the risk of a second wave. So this is despite the lockdown restrictions being eased, despite slowing COVID-19 infection rates, that's causing a lot of concerns too. But the thing to remember amongst all of this is that we have markets with very stretched valuations. The US, the S&P 500 forward PEs are in excess of 24. In Europe, PEs historically are very high, with the Euro Stoxx 50 at 19.5 and the FTSE 100 at 18.5. Markets just kind of need to take a pause for breath. They've done a lot very, very quickly. We obviously had quadruple witching last Friday, lots of volatility. We've got year-end, half-year-end coming up now, so expect a lot of window dressing to come along too. I think it's just a time to see what happens over the next 3 months with the potential for second wave of infections coming out in the US and in China, less so in Europe.
Yogi, we had Freddie late on last week from Latitude, and he said it's not hard to put together a portfolio trading at 15.5 times forward, and he gave us a few stocks in his portfolio that he thought would do well in the current environment over the medium term. Are you struggling to find those kind of valuations?
You know what, you can buy value-orientated names, you can find cyclicals, but the reality of the situation is these sectors have been hit really, really hard. And if you do see a second wave, and it's very early days, you will likely see those sectors not do so well. Our view here is we're just slightly underweight. We're just waiting to see how this plays out over the next 3 months. It's a range-bound market. You've got good entry points, by all means build exposure, but you've got to think beyond COVID-19. You've got to think beyond 2020. You've got to look out into 2021. And you've almost got to ignore what's going to happen with Q2 earnings. Those numbers are going to be really, really dire. The saving grace to all of this is that we have had improved trade discussions between the US and China. We have had better economic data than people have expected. Retail sales, unemployment data, PMI data, all improving. The big risk out there is obviously election risk in the UN. Biden is extending his lead in the run-up to the elections in November. Polls are suggesting he's got 50% of the vote. And that's not so market friendly, although markets may respond to it in a more positive way than we expect. There's lots of reasons to build exposure, but build it gradually. And the backdrop to all of this is, of course, bond markets are extremely overvalued at the moment, probably more so than equity markets, which is why you've seen all the volatility that we've seen.